Welcome to Blue Bridge Insurance Group. My name is Ryan Smith, and today I'm going to be explaining what is a multi-year guaranteed annuity. So multi-year guaranteed annuity, commonly referred to as a MYGA, is essentially the insurance industry version of a bank CD. There are a couple of slight differences, but there are a lot of similarities to bank CDs. With a multi-year guaranteed annuity, you will have a fixed contract length and you'll choose how long of a contract you want. Common contract lengths are 3 years, 5 years, 7 years, and 10 years. And you will have a fixed interest rate that's locked in, it can't change, it's not based on any type of underlying index or moving parts. It's a simple fixed interest rate. And most of those fixed interest rates are compound interest as well, where if you're not taking withdrawals, then your interest is going to continue to compound each year that you leave the funds in there. One of the primary differences between MYGAs and CDs are that CDs force you to receive the interest at the end of each year and you have to pay taxes on that interest. Whereas with MYGAs, you do not have to take the interest at the end of each year. It's up to you whether or not you want to take some withdrawals from your MYGA, but you can certainly leave the funds in the MYGA, which allows your interest to compound tax deferred, which is a big benefit of a MYGA over a CD. As far as the free withdrawal provisions from the MYGA, different annuity contracts are going to have different free withdrawal provision, but common free withdrawal provisions are 5% of the total accumulated value each year. Some offer up to 10% of the total accumulated value each year. Some offer the interest that has accumulated over the last year as free withdrawals, and some allow the total cumulative interest as free withdrawals within a year. So it's important that you understand what your liquidity provisions are within that annuity to make sure that you're withdrawing the amount that you need and that you're not going to be penalized for doing so. Another important provision of MYGAs is whether or not your death benefit is going to be the full accumulation value or not. So most MYGAs allow the full accumulated value to pay out as a death benefit. If you pass away before the end of the contract, your family will receive the total accumulated value with no sort of penalties or anything like that attached to it. A few MYGAs do have surrender charges that apply if you pass away before the end of the surrender period. So I don't offer any of my clients contracts where you're going to have any type of surrender charges that would apply if you pass away before the end of the contract, because my clients, they want their family to have access to that full accumulation value with no penalties and no surrender charges if they do pass away before the end of the surrender period. So a multi-year guaranteed annuity, again, it's a very similar product to a CD. It offers a fixed interest rate. It's going to offer some type of free withdrawal provision in it. The death benefit is typically the full accumulation value if you pass away before the end of the contract. And then at the end of the contractual period, you're going to make a decision on what you want to do with your funds next.